In the closing weeks of 2025, as holiday shoppers hunted for presents, a monumental shift unfolded quietly within the realm of international finance, one that's received far too little attention. Experts have dubbed it the Great Trillion-Dollar Repositioning, with more than $1 trillion reallocating in mere weeks. Major players like Vanguard, BlackRock, State Street, CalPERS, Norway's oil fund, and Japan's public retirement system all acted in unison, offloading their high-performing assets, pivoting toward bonds, and adopting a more cautious stance. Outlets in the press dismissed it as standard end-of-year adjustments, mere maintenance of investment mixes. Nothing out of the ordinary, just keep going about your business. But that's not the truth. This move signals alarm. It's like a distress beacon launched high, hinting at impending turmoil. What few are revealing is that this scenario has repeated itself thrice in documented annals. In ancient Rome, Weimar-era Germany, and during Europe's Middle Ages, each instance heralding total financial downfall. As we stand in January 2026, America's public debt has reached $38.4 trillion. You absorb that figure, $38 trillion. It grew by $2.25 trillion over the past 12 months alone, equating to roughly $8 billion added daily without pause for weekends or festivities. $8 billion every single day. The cost of interest on this borrowing has now surpassed $1 trillion yearly. Emphasize that, $1 trillion solely for interest, not touching the core amount. This ranks as the government's second highest outlay, trailing only Social Security and exceeding defense spending, Medicare, and all other categories, save one. Now, the savvy investors are fleeing. Vanguard, overseeing $11 trillion in assets, has overturned its core strategy. They're advising a reversal of the classic 60-40 split, 60% equities, 40% fixed income, which has served as the benchmark for secure, steady investing since the 80s. Instead, they're pushing for 40-60, lighter on stocks, heavier on bonds, prioritizing protection over growth, accepting diminished gains for greater stability. Their lead economist described it as a fundamental upheaval, not minor tweaks, but a profound transformation. Those were his precise terms. This isn't about optimizing profits. It's about bracing for survival. The elite capital sees a storm brewing, one so severe they're trading potential upside for security. They're not isolated in this. During December 2025's final fortnight, large-scale funds shifted over $1 trillion, liquidating positions in technology leaders and the so-called Magnificent Seven, NVIDIA, Microsoft, Apple, Amazon, the darlings of the AI boom. These aren't being sold due to company weaknesses or the end of artificial intelligence. It's because prices are inflated, hazards are elevated, and in a systemic breakdown, few assets remain untouched, except the truly fortified ones. This isn't guesswork or forecasting. It's identifying recurring trends, and the trend is unmistakable. All dominant monetary frameworks adhere to a consistent four-phase cycle. Every dominion, every form of money, every administration attempting to borrow beyond its means follows this inexorable, formulaic path. Phase 1, the bedrock. Systems begin with reliable currency anchored by genuine worth. Gold standards, silver reserves, physical items that can't be fabricated endlessly. Authorities expend only what they gather. People have confidence in their holdings. Commerce expands organically. Costs hold steady as currency expansion aligns with true productivity. This forms the solid base, the era prior to irresistible lures taking hold. Phase 2, growth coupled with dilution. Then, circumstances evolve. Conflicts, building initiatives, welfare schemes, grand visions, emergency expenditures. The state's demands outstrip its inflows. Levies fall short. Citizens push back against increases. Yet commitments persist. Duties accumulate. Thus emerges the expedient, currency weakening. Initially, it's understated, almost imperceptible. A minor cut in metal purity, a gentle boost in supply, framed as interim until recovery. At the outset, it's overlooked. Notes and coins appear unchanged. Daily life proceeds, but the line has been crossed. Leaders have unlocked the ability to generate buying capacity without equivalent creation, to allocate without extraction, to pledge unbound. Once tapped, this tool proves addictive. Phase 3, turmoil and spiraling chaos. The erosion quickens. From modest percentages, it jumps to double digits, then halves the value. More funds are required for escalating vows and issues spawned by prior dilutions. Inflation creeps up, then surges, then explodes. Individuals sense their buying strength waning. Traders reject the tainted money or insist on extra. Officials counter by issuing even greater volumes, fueling the vortex. Confidence dissolves. Folks stockpile tangible goods, property, raw materials, precious metals, anything beyond official assurances. Money circulates faster as holders rush to offload it before further devaluation. Regimes impose caps on prices, salary limits, forced acceptance rules, restrictions on outflows, all aimed at compelling compliance with the flawed tender. None succeed. The money turns worthless, burdensome, something to shed swiftly. Societal bonds fray. Institutional trust crumbles. Here, peril escalates. The trajectory becomes unstoppable. Phase 4, the unavoidable endgame. The structure shatters utterly. The tender either inflates wildly or is ditched wholesale. Exchange reverts to swaps. Governance can't sustain essentials. Order unravels. Those who anticipated and shifted to solid holdings endure. Believers in state vows clutching the currency face ruin. A fresh order arises, often rooted in stable backing once more. The loop restarts. After some decades, with recollections dimmed, the sequence recommences. This isn't conjecture or personal view. It's verified chronicle. Allow me to demonstrate. In the 2nd century CE, Rome dominated Western Europe, segments of North Africa and the Near East, governing 65 million souls, about a fifth of humanity. The denarius served as the planet's key tender, pure silver 4.5 grams strong, honored from Britannia to the Euphrates. For 200 years, it held its integrity. The realm prospered. Pathways linked 3 landmasses. Engineers crafted enduring highways, water systems, metropolises. Armies secured frontiers. Revenues were gathered effectively. Finances, largely even. This exemplifies Phase 1 at its peak. Sustaining such vastness proved costly, though. Expeditions drained treasuries. Frontiers stretched, demanding additional troops, outposts, oversight. Public aid expanded. Rome's grain subsidies nourished multitudes. Lavish spectacles ballooned. Nero erected his opulent palace. Mines yielded less silver. Incomes lagged expenditures. In 64 CE, Nero opted fatefully, dropping silver to 93%. Merely 7% less, hardly evident, purportedly short-term. Later rulers amplified this. By Marcus Aurelius's era, it dipped to 75%. The base was fracturing. I'm not urging blind faith. Examine the figures independently. All references are accessible via links below. Treasury records, legislative documents, Fed statistics, live debt monitors, everything's available. Save those sites, monitor them regularly, observe the escalation firsthand. Once witnessed directly, it's indelible. Then you'll grasp why elite funds are repositioning presently. The 3rd century CE brought what scholars term the crisis of the 3rd century. The Antoninianus supplanted the denarius, valued at twice, but massing only 1.5 times more. By mid-century, coins held scarcely 5% silver, copper centers with flimsy plating that eroded quickly, exposing the deceit. Costs skyrocketed. An item once at 1 denarius now demanded 50, then 100, then multitudes. Troops sought raises. Regimes minted degraded coins to compensate. The whirl intensified beyond restraint. In 301 CE, Diocletian decreed price ceilings on over 1,000 items and labors. Breaches punishable by death. Execution for overpricing loaves. It flopped entirely. Vendors halted sales. Underground economies thrived. Bartering eclipsed money. The fiscal order imploded. By century's close, prices stood 70-fold higher than 2 centuries prior, most escalation in the last 10 years. Societal ties severed. Evasion of duties became rampant. Local warlords rose. Central power eroded. The Western Empire slid into irreversible decay, staggering another 200 years until 476 CE's demise. Identical progression, phases 1 through 4, each foreseeable. November 1918 saw World War I conclude with Germany's defeat. Versailles imposed harsh conditions, land cessions, armed forces curbs, 132 billion gold marks owed, a crippling load meant to hobble the nation indefinitely. The Weimar Republic shouldered this, a shaky government steering a shattered land with unpayable obligations. Before the war, Germany boasted solid currency, the gold mark, steady and credible, supported by a top-tier economy. Industrial prowess shown. Phase 1 intact. But the indemnities overwhelmed. Collections proved inadequate. The populace, drained and destitute, balked at hikes. Payments were mandatory, lest France strike. Printing ensued. Subtly initially, the mark depreciated from 4 to $1 to 8 to 16. In 1922, a missed installment prompted French-Belgian seizure of the Ruhr, the industrial core. Officials urged nonviolent defiance, no collaboration, strikes. Yet idle laborers required wages. Production halted, no funds incoming. Thus, as faltering states do, they flooded the market with notes. Presses operated nonstop. Dilution went parabolic. In January 1923, bread fetched 250 marks. By November 1923, that very loaf of bread demanded 200 billion marks. Not millions or trillions, but billions, for a single purchase. Citizens wheeled barrows stacked with bills just to afford basic food items. Employees insisted on receiving wages twice daily, rushing to use them before further erosion in worth. Life savings vanished in days. The working class was devastated. Elderly on fixed incomes faced hunger amid chaos. Currency turnover hit extreme speeds, with no one willing to keep marks for more than moments. Tangible holdings emerged as the sole reliable preservers of wealth, property, precious metals, overseas money, or anything beyond the failing local tender. Society's stability eroded rapidly. Radical ideologies gained traction. By late 1923, $1 fetched 4 trillion marks. The tender had lost all practical utility. Authorities scrapped it, launching the Rentenmark, secured by real estate loans. The runaway price surge halted, yet the scars endured. A whole era's prosperity was erased via inflation. Confidence in governance crumbled irreparably. The road to authoritarianism was set. Identical sequence, identical phases, identical result. Unavoidable. In the early 17th century, the 30 Years' War drained coffers across Europe. Princes in the Holy Roman Empire's German states grew frantic. Their rural subjects were destitute, and incoming funds had evaporated. Yet conflicts required financing. Prior to the upheaval, German silver pieces held steady mass and quality. The Thaler, or Groschen, dependable tenders enabling commerce throughout the continent. Phase 1, operating smoothly. War demands escalated costs. Rulers learned they could dilute their mints, extracting surplus material for additional strikes. They deemed it clever. Agents known as clippers shaved coin rims, while washers stripped silver from alloys for reuse. They'd collect 10 units, liquefy them, mix in base elements, and produce 11. Seemingly effortless gain, or so it appeared. Each leader diluted modestly at first, then aggressively, realizing competitors raced downward too. By 1622, the tampering was blatant. Units meant to match varied wildly in heft. Many were largely base metal. Silver ratios fell from 90% to 20%, then 10%, approaching nil. Costs ballooned instantly. Traders shunned the pieces or required multiples. Cross-border exchanges halted. The marketplace froze solid. No one could distinguish authentic from fakes. Credibility dissolved utterly. The fiscal framework shattered. In 1623, imperial forces compelled the leaders to cease. They withdrew the tainted issues and released fresh tender, inflicting huge devaluations on owners. Wealth vanished en masse. A complete economic structure needed rebuilding from zero. The insight lasted briefly. But after one lifespan, recollections dimmed. The allure resurfaced. The loop recommenced. Another case. Consistent sequence, consistent phases, consistent downfall. The cycle holds firm. Now, let's connect this to today, to the U.S., the worldwide monetary setup, and events unfolding as you absorb this. The U.S. exited Phase 1 in 1971 with Nixon's suspension of gold convertibility that severed the dollar from any concrete anchor. It turned into sheer decree money, a pledge, a note of debt reliant on belief. For the inaugural instance globally, the primary reserve tender lacked inherent worth. It functioned via collective agreement, bolstered by U.S. economic supremacy and lack of rivals. From 1971 onward, the approach stayed steady. Outlay beyond receipts, generate funds to bridge gaps, inflate the base supply, swell obligations, cycle endlessly. Federal borrowings in 1971 totaled $398 billion now, at $38.4 trillion. A 95 times multiplication, or 9,500% growth across 54 years. But note the speed up. It passed $34 trillion in early 2024, $35 in mid-2024, $36 late that year, $37 in summer 2025, $38 by fall 2025. Adding $1 trillion roughly every 5 months, the quickest build-up barring crisis responses amid alleged prosperity. This marks Phase 2, ramping sharply. Here's our current spot. Yearly debt servicing topped $1 trillion. That exceeds military allocations entirely. It's the runner-up in federal outflows after only retirement benefits. Projections from the Budget Office foresee servicing at $1.8 trillion by 2035, totaling $13.8 trillion in the coming 10 years. Prior decade, $4 trillion. Upcoming, $13.8, a 350% jump. Servicing as a share of inflows reached 15% for 2026. Over 15% of tax collections now funds just the charges. Not principal reduction, merely charges. The central bank's holdings ballooned from below $1 trillion pre-2008 to above $8 trillion presently. That's outright fund generation, electronic minting, contemporary dilution. Aligning the bank's growth against Rome's silver reduction graphs shows matching paths. The decline rates align precisely. The buildup mirrors exactly. We're tracing the identical route. And the savvy capital is shifting. In December 2025's closing fortnight, major holders performed what's termed the grand adjustment. Beyond $1 trillion relocated. Entities like BlackRock, Vanguard, State Street, CalPERS, the planet's vastest, most prudent overseers. They avoid rashness. They shun fads. They adjust methodically. Yet they transferred over $1 trillion to safeguards in 14 days. They're unloading NVIDIA, Microsoft, Apple, Amazon, the elite 7 tech drivers of the upswing, the entities with top basics, peak expansion, sturdiest finances. They're offloading, not due to firm declines. Because when equity-heavy mixes swell, they skew toward shares. To realign goals, they sell victors and acquire fixed income. Procedural, they claim. Standard tuning. But here's the unspoken. They might alter goals. They could pursue the risers. They could follow surges like individuals. But no. They're intentionally reducing exposure, strategically fortifying, purposefully readying for the horizon. Vanguard's shift isn't mere tuning. It's a core outlook reversal. Their top analyst put it plainly, domestic shares are inflated, pushed to hazardous extents. Fixed income yields comparable gains with diminished peril. Overseas equities to eclipse U.S. ones in the next 10 years. Not routine counsel, a caution, an alert, an indication of profound issues. The 40-60 setup projects 5.7% decade-long yields against 5.3% for 60-40. Near identical outcomes, yet volatility at 6.9% versus 9.3%. Far safer for basically equivalent rewards. That reveals all. Equity, risk benefit has fractured. This is phase 3, the upheaval stage, command slippage, the instant dilution speeds past reversal. Authorities can't halt. 38 trillion borrowings need constant rollover. 1 trillion yearly charges demand settlement regardless. Retirement and health funds near exhaustion in 7 years. Security outlays won't drop in a volatile globe. Infrastructure demands swell hugely. Inflows, even amid robust expansion, fall short of duties. Equations fail, figures mismatch. Thus, funds get fabricated, borrowings grow, dilution hastens. No alternate route, no option, no escape but via phase 4. Ex-Treasury head Janet Yellen recently voiced a dire alert. The nation nears debt supremacy. Where obligations swell so vast, the bank forfeits inflation mastery. It can't elevate rates against price rises, as hikes render servicing untenable. Stuck. The charges inject funds, stoking further rises, a self-reinforcing cycle. When Paul Volcker tamed surges in the 80s with 20% rates, borrowings were 25% of output. Maneuver space existed, fiscal tweaks possible. Today, 120% of output. Rate effects hit immediately. Governance can't sustain elevations. The bank has yielded authority. Eventually, timing uncertain, belief fractures. Globally, doubts arise on dollar stability. Overseas banks trim U.S. holdings. Tender demand wanes. Value drops quicker. The bank confronts a bind, boost rates for defense, tanking activity and crippling servicing, or hold low, permitting surges that erode buying strength and faith. Both lead to breakdown, both fulfill the cycle. Phase 4 turns certain. In that shift, intrinsic value holdings will boom. Terrain, resources, metals, viable enterprises, since the tenders themselves diminish drastically, possibly to irrelevance if the loop finishes. Those intangibles persist. Holders of state vows and tender-based fixed income see fortunes fade, akin to Romans clutching diluted denarii, Germans with marks, all through eras who favored official assurances over fiscal truths. The sequence advances live, phase 3 speeding to 4, schedule unclear, endpoint assured. Let's tackle the trio of expert rebuttals, the 3 claims to refute this view. This era differs. No, each crumbling setup claims uniqueness. Rome viewed its realm as timeless, unbreakable, pinnacle of society. It fell. Weimar's advanced production thought it could endure. It didn't. Feudal leaders believed their smarts outwitted consequences. They failed. The U.S. assumes its key tender role, armed might, tech lead grant immunity. They don't. They merely amplify the final reckoning, more fierce, more ruinous, more total. Advancements will rescue. No, innovation doesn't alter arithmetic. Efficiency boosts can't nullify endless overspending. AI won't cure budget shortfalls. Virtual tenders don't erase dilution urges. The press didn't aid Weimar despite era's progress. Rome boasted unmatched builds, paths, channels, during mixes. It didn't preserve them. The clipper washer era saw coinage breakthroughs. Progress never halted this loop. Ever. U.S. uniqueness sets it apart. No. All dominions claim superiority until they don't. Rome excelled for 800 years, then ceased. Spain shone with colonial riches, then dimmed. Britain ruled endless domains, then relinquished. U.S. fiscal lead isn't eternal rule. It's a post-war artifact. Those factors shift. The lead wanes. The superiority is a myth upheld by history avoiders. So, your actions? You can't derail the cycle, can't sway policy, can't mend fiscal paths. But you can ready for endurance. Grasp real holdings versus pledge assets. Real ones hold worth sand state backing. Terrain yields sustenance despite tender woes. Resources serve production unchangingly. Metals can't be conjured endlessly, ignoring bank outputs. Thriving firms produce flows in any medium. Pledge assets, fixed income, tender, state papers rely on authority's capacity and intent to uphold. Records prove that falters, invariably, without fail. Mirror the astute funds. Vanguard's 40/60 isn't gloom-driven, it's risk-savvy, valuation-aware, insider-informed. When globe's biggest, steadiest overseers fortify, that's not advice, it's an alarm, a beacon, your signal to heed, spread holdings globally. The U.S. is far in phase 3, others vary in progression. Global spread avoids total reliance on one regime's prudence. Vanguard forecasts overseas outpacing domestic over 10 years. Not bias, calculated review of prices and prospects. Keep ready funds, but avoid extended locks, liquidity for chances and crises, yet not in decades-long state papers if they shed value. Brief-term options, cash equivalents, movable holdings. Shift swiftly as shifts occur, cycle quickens, phase 4 nears. Study fiscal pasts. This piece is a start. Explore Rome's tender dilutions, examine Weimar's price apocalypse, grasp the clipper washer debacle, review Zimbabwe, Venezuela, Argentina, Turkey, Lebanon. The loop recurs as behaviors persist. Regime drives endure. Debt dilution math stays fixed. The trillion-scale adjustment isn't seasonal upkeep. It's institutional awareness of phase entry, riskier where the cycle rushes to close. Rome's fall spanned ages, gradual then abrupt. For eras, all appeared stable. Growth continued. Forces triumphed. Dilution crept unnoticed until it didn't, until tender imploded in a decade. Weimar spanned years, not ages. The mark declined steadily, then disastrously. 1 million, billion, trillion for bread. Seemed absurd, but math was straightforward. Regime required unavailable funds, so printed relentlessly until paper shortages. We're not at terminus, not quite. Not in phase 4, but entrenched in 3. The sequence progresses. Astute funds acknowledge. They position. They shift trillions to affirm. The issue isn't if the cycle ends. Records confirm yes. The issue? Your response? Reject as pessimism? Assume difference now? Credit assurances of stability? Or scrutinize figures, review pasts, comprehend the cycle, and adjust? Institutions act. Savvy capital pivots. Indicators abound for observers. Your turn. Don't merely observe. Join this feed for the follow-up, where I detail surviving assets in total dilution versus those erased. Past figures are definitive. The cycle is firm. Upcoming shifts dictate your economic fate. Join now, activate alerts, pass this to those needing subsurface insights. As the cycle persists, the process continues, and moments dwindle.